Hey everybody, welcome to Everything Accounting. I'm Alfred, your friendly neighborhood CPA, and I wanted to talk to you guys today about debt and strictly understanding it. When it comes to debt, obviously we all hear about debt. There's credit card debt, there's loans, there's car payments, there's all these different types of debts that come up. But the one thing that I want to address is that it's not all bad. There's always a stigma against getting debt, but I think it's just really important to understand debt, what it should be used for, and kind of how it can be applied to you as a business owner. Here's a few tips, tricks, and some pieces to understand when it comes to managing or taking on debt. So one thing that I find with a lot of my clients that they tend to do before coming on or before talking to me about it is they take on loans or credit card debt or anything of that nature strictly to pay off other expenses. So they have a need of, say they take a $50,000 loan from the bank and they use that to pay down accounts payable, to pay down different investors, different expenses, whatever it is. That's all great and good, but unfortunately, once you've used up the money, once you've used up the 50,000, you're back to square one. But it's actually worse off because now you have to pay this back, and on top of it, you have interest to pay on it because no one's going to give you an interest-free loan. So obviously, when all things are said and done at that point, you have a ton more debt to take on. So when we're talking debt, you really need to understand what you're going to be spending this money on. You don't want to spend debt or loans or anything of that nature on other debt. So as an example, you don't want to use any loans or anything of that nature to pay down accounts payable or to pay down your credit cards. That's just transferring your debt from one end to another. Doesn't make any sense. I always have a rule of thumb that if you're going to take on debt, if you're going to take on a loan of any nature, it's really important that you know what the return on that spend is going to be. Meaning, you need to be able to spend that money on something that will bring in more revenue or add major value to the organization. Otherwise, you're just mismanaging funds. So when it comes down to taking on, again, using the example as a $50,000 loan, what you could be using that money for is, in my case as an accountant, I could use that money to hire an additional staff to allow me to go and get more clients because now we have increased our capacity. If in terms of a construction company, that debt can be used to purchase equipment that'll be used day to day and invoiceable day to day. That could be funds that you spend on projects that eventually will lead to more profit. So you want to evaluate what you're spending that money on and make sure that it has to do with any spend related to increasing revenue for the business or systematically reducing your costs. Because at the end of the day, it's profitability that you're looking at. The other way to evaluate it, and the real big way to evaluate it, is what the return is on that investment. So you'll always hear the term ROI, and that is return on investment. But this is applicable not just with stocks and investments of that nature, but it's also the return on any loan that you're taking. So say you're getting that 3% return on your revenue year over year, and it's going to be consistent for the next 5 years. At a 5% cost of interest for the loan, if you assume that 3% will actually lead to you being able to pay back the 5% loan in 2 years, but you know that you have revenue coming in for 3 more years after that, then that's easy math. Like, it makes sense to do that. So the only reason why I'm bringing this up, and there's a lot of numbers here and there's a lot of calculations, and if you're not a numbers person, please go talk to your accountant, go talk to your financial advisor, all that, before making these kind of decisions. But evaluating these kind of numbers, it leads to the thought process that, hey, this could be worth it in the long run. even though the return isn't equal to the interest you're paying, it's the time that you're actually paying on the interest as well. It's really, really, really important to understand what you're getting yourself into. The problem that a lot of people find, and I'm sure you'll see this on websites all over the place, you'll see this on different YouTube channels, you'll see this on different TikToks and things like that, but they're constantly saying people only look at the monthly bill and they don't look at the overall cost of the loan or the lease or anything of that nature, which is unfortunately true. You look at what you can spend month over month. But what you also want to evaluate is paying that back month over month, but you're also yielding a return on it significantly higher, then it's worth it, right? Don't overextend yourself. Don't take on debt that you won't be able to do, and don't take it on if it's too risky. Because debt, at the end of the day, the bank will get its money. There's no question about it. Any debtor will get their money. It's just a signed contract. It's guaranteed. If you think that, hey, I'm going to be able to get 10% on this return, but there's a 50-50 chance it doesn't happen, then you might want to double think it. You might want to take a second to evaluate, hey, is it worth taking that risk? And that is a you question, not an anyone else question, because then we're talking about what kind of risk are you willing to take on? Are you risk averse, meaning that you don't like to take on risk, or are you very risk neutral, so you don't care about taking on risk? It really depends on you as an individual, you as a business owner, and evaluates what you are willing to do in the time that you're in. So for me, I prefer not to take on debt. I prefer to see if the business can sustain itself and grow itself, and I use the profits year over year to scale the business. But sometimes there's business owners that are like, I need to take this on because there's a massive opportunity that's coming up and I need to be ready for it. I need the cash for it. That's not a bad way to go either. It's just really an understanding what your parameters are, what you're able to do, and what you're not overextending yourself. So it really comes down to you as an individual and you as a business owner. So overall, debt is not a bad thing. And I just want to emphasize that a little bit more. Debt is not a bad thing, and it can be very useful as you're scaling, as you're growing, as you're expanding your businesses. Debt is only bad when you're using that debt to pay off other debt, or you're using that debt to pay for things that don't yield a return. Because at the end of the day, you're paying more on that debt than you're getting back to you. Don't go take out a $50,000 loan to then go shopping or go on vacation or buy a Rolex or what. All these things are of zero value at the end of the day. It's not like you're going to go around and sell these for more consistently. Sure, maybe the Rolex, but realistically, you're not buying these things to make money. You're buying these things for whatever purpose, for comfort or that level of comfort that you're looking for. But at the end of the day, that's not going to yield any return. What you really want to focus on is if you're taking on debt, it's for a bigger, larger purpose. So even going down to the simple example of using a loan to go to school. You evaluate your student loan or for, I know quite a few doctors and they take loans to go to med school. The return on that is exponential, so long as they make it through med school. They're going to be able to pay it down within 5 years after getting out. They're going to be able to make a lot more money because of that loan. It's worth it, right? At the end of the day, over a 30-year term, they've made 10x what they took out in loans. It's the same thing for student loans. If you're taking out a student loan and you think that at the end of your 4 years or however long you take to finish your degree, if you feel like, hey, I've taken out this debt, but I know that this specific degree is going to allow me to take on way more in revenue, way more in earnings than I would have otherwise, then yeah, it makes sense. Just don't go taking out a loan to be like, hey, I'm going to go buy a car. One of the most depreciable assets there is. Even if you bought a car outright and you didn't take a loan, you're going to lose money at the end of the day when you go and sell it. because it just depreciates year over year. It's not going to add value. It's not an investment. So when it comes to debt, you want to look at using that debt to invest in your future. And it needs to yield a return higher than what you're paying in interest. So take that with, again, a grain of salt. Really, before making any financial decision, it's really important, and I emphasize this as best as possible. And this is probably the one thing that I will constantly say, is when we're talking debt and we're saying take on debt or don't take on debt, you have to talk to a trusted advisor. You have to talk to a trusted accountant that you know. You have to talk to a trusted financial advisor that is not going to benefit from taking that loan. And that's another thing that you really need to focus on, is whoever you are talking to should not benefit from the exchange, should not benefit from the transaction. So please go talk to a professional, talk to a trusted advisor before taking on any debt. But if you've calculated out the information, if you've calculated out how it'll benefit you, and you see that it'll yield a return, it'll yield a benefit or an ROI, a positive ROI, then do it. When it comes to financial management, when it comes to finances at all and accounting, understanding numbers is really important. Understanding the usefulness of finances is really important. That's what helps you grow when it comes to accounting. If you understand your financials, if you understand the debt instruments you're taking on, if you understand how equity works, if you understand how your assets work, all these items, you're bound to succeed. But you need to understand, you need to build up a knowledge base to basically dictate how you're going to improve and how you're going to grow. So take a second, read up on it, ask an advisor, ask an accountant, ask me. Feel free to reach out to me, and I'm more than happy to help you with any requirements, any requests, or any type of understanding for loans or anything of that nature, or debt. And we can kind of go from there and discuss how it'll best benefit you. So anyways, long story short, this has been debt and understanding debt and when to use it to your benefit. If you have any questions, please comment below or subscribe to the channel, and obviously hopefully you can benefit a little bit more from some of these videos. But please reach out, please feel free to ask me any questions. I'm here, I'm ready to answer all your questions. So as always, this has been Everything Accounting. I'm Alfred, your friendly neighborhood CPA, and please reach out. Thanks.